If you're looking to lower your tax bill, this video is for you. We're going to walk through one of the key ways to lower your tax bill, both while you're working and in retirement, for anyone in Canada or even abroad as well. By far, the number one question I get is, Adam, how do I lower my tax bill? What are the ways? There's got to be secret sauce. And there's not really secret sauce. There's one little one that I'll cover later in this video, but the two primary ways to lower your tax bill on the simplest levels are utilizing an RRSP. So as you make money, employment income, put money into an RRSP to get a tax deduction to lower your tax bill. The second way to do it, which we're going to talk about today, is donations. And a lot of people say, Adam, I'm not religious, I don't make donations. Well, look, people make donations for many reasons. There's a lot of great causes out there. And I encourage you, if you're looking for a tax break and looking to make a difference for a charity, it could be a local hospital, it could be a religious group, it could be a group that helps, and this is one area that we help out, is rescuing girls from sex slavery. There's a lot of things out there that you can donate to and help out with. But today I want to show you in software how that donation helps you on the tax side. It's a double whammy in that it's helping you and it's helping a good cause. So let's break it down in the software. So here's our couple, Dave and Ruth YouTube, who we've seen quite a bit here lately. And they are 60 years old in this scenario, retiring at 65. We've mapped out a plan for them. And they have a substantial amount of savings. And they're running their income almost $100,000 a year after tax and adjusted for inflation. And they've requested that all the way down to 90. So substantial income and more than they're looking for. And so they asked us, Adam, this is great. There's a lot of money here. We don't have an estate plan as far as like kids to leave it to. So we're never going to spend this. So do we just kind of spend what we can and leave it to the end, and our estate will give it to the charities that we list? Or is there a way to help charities ongoing and also help reduce our tax bill as we go forward, both now while we're alive and also at death? So what we do, and we do this quite often with clients if they ask for this, is okay, let's actually build in some donations while you're alive. It's going to lower your tax bill now. It's going to make, an immediate impact to these charities or organizations that you want to help out. So it's a win-win. So what we did for Dave and Ruth in this scenario is we said, let's just start, with a nominal number of $10,000. So you can see here that once they hit retirement, they're going to start donating $5,000. So you can see on Dave, he's donating $5,000 of cash. And if we went over to Ruth, the same thing, the same $5,000. So they're going to allocate $10,000 a year of their $99,000 income over to a charity of their choice. Now, if we go into a combined view, again, they were making $99,000 before, they're now down to $95,462. So their income drops by $5,000, but they were able to give away $10,000. And the reason for that is when you donate money, and we'll put the link below to the CRA website, but when you make a donation, you get a tax credit. And it works out to essentially close to the top marginal tax rate, meaning that you're going to get close to 50% back for every dollar that you donate. It's a bit less than that, but think of it this way. For every dollar you donate, 50 cents will come back to you in the form of taxes, and the full dollar goes to the charity of your choice. So this is where donating is a great tax strategy if you have extra money or if you want to help a great cause. Now, I'm going to get lots of comments on this video. I already know it because we've done one similar to this years ago, in that, Adam, if I put money into my RRSP, it's a tax break and it's my money still. Like, I still control that. I can take it out. It's my money. If I donate money, that money's out of my control. It's no longer mine. Absolutely. If you're going to donate money, you're giving it to a charity organization of your choice, and that's theirs now, and you're getting the tax break. And typically people will make donations for the tax break, and also because it's an organization or a cause near and dear to their heart. And so for my wife and I, we have a few organizations that we help out that are near and dear to us. We're actually going to bring a couple of them on the channel here in about a month or so and just share their story, how they raise funds, all that kind of stuff. Because I think it's good for a lot of people. A lot of people in Canada don't make donations and they don't help great causes around them. But again, the donation, as you can see here in the software, donating $10,000 a year is only reducing their net income by $5,000 and allowing that organization to have $10,000. So it's a great tax benefit and a great way to help a great cause. Now, one thing we typically add up when we build out a financial plan, we look at what is the total nominal dollar you're going to collect. So if we jump back into the software here, the nominal dollar amount is the column here beside. So real dollar is level, so 95,462, but that's adjusted for inflation. So the nominal dollar is the dollar amount that the client will actually collect in their pocket. So you can see at 65, 95,462 today's dollars in 2028 is worth 110,667. So that's how that works. When we build out a plan, we will always look at what is that nominal dollar amount? Like how much are they actually going to collect in their pocket after tax? And if we look at scenario one, where the income was $99,000, the total nominal income was $4.94 million. So a substantial amount of money, but that's the total amount of money from age 65 to 90 that they're going to collect. Now, if we look at it from a donation standpoint, it's going to be reduced obviously because they're collecting less income, and it's $4.77 million. But they've donated $250,000 to charities as well, and it bumps that nominal income. If you add what they collected along with what the charities got, total after-tax income is $5.03 million. So of course it's more money because we've reduced our tax bill through that tax credit. So again, a lot of people say, yeah, but we're getting less money. But if you add what you're getting and what the charity's getting, is going to be more because of that tax credit. Now let me jump into a tax strategy that a lot of you don't know about, aren't utilizing, and should start to consider. Now, it doesn't work for everyone. You have to have a non-registered investment account. But if you have a non-registered investment account that own individual shares or funds or some sort of investment that has a large gain to it, you're actually able to donate that share, that mutual fund, whatever it is. So let's take a stock as an example. Let's say you bought Microsoft stock and it went from $10,000 to $20,000. If you were to sell that Microsoft share, you're going to have $10,000 of capital gains, the difference between what you paid for it and what it's worth today. So let's say you said, you know what, I want to donate $20,000 to a charity. And you say, you know what, that Microsoft share, let's just sell that and donate it. So what's going to happen is you're going to sell that Microsoft share, $10,000 of its capital gain, so $5,000 of it adds to your tax, and let's say you're in a 50% tax bracket, you're only going to have $17,500 left after you paid your taxes. So you've lost $2,500 of benefit. Now again, this can scale to 100 million at any scale. We're using a scale of 20,000. Now, let's say you donate the shares, which a lot of people don't realize you can do. So what this client could do is, let's donate the $20,000 of shares directly to the charity. So not selling the Microsoft shares, but actually donating those shares to a charity. What you're going to do then is the shares go to the charity, you're going to get a $20,000 donation receipt, and the charity can sell it without any capital gains. Their cost base becomes what you donate to them, the $20,000. So in essence, we've had $10,000 of capital gains that typically will have taxes attached to it, more money for the CRA. That's completely wiped out. So if you're there with a non-registered account with some capital gains on an investment and you're looking to make a donation, consider donating stocks or equities in kind. And again, what that means is you're not selling whatever you're going to donate, you're not selling it first, you're donating it in kind. Most charities in Canada will be able to accept in-kind securities. So if you're looking to donate securities and you're looking at an organization, reach out to them, ask them if they can accept in-kind donations. Most of them can, but it's a great way to double dip because you're avoiding the capital gains tax and you're getting the donation tax credit. It's one of the only times and only areas that CRA allows that double dipping, right? We always think like you have to have an offshore account in the Cayman Islands. Well, the reality is donating a stock that you've had appreciation on to a charity, you're double dipping on tax. So that would be one great tip on how to make a donation and how to get a double dip on your taxes.